So good evening, everybody. Thank you for taking the time to come here today, both the presenters as well as people in the audience. We appreciate everybody's time. By way of introduction, my name is Vinan Gala. I'm the chairman of the Affordable Housing Committee for the town of Rocky Hill. I'm going to do a quick introduction of the. Got Alan Smith here. We got Charles, Genevieve, Tom, and Daya, and then we have Kim, who is our town planner. With that, I want to, most of you have seen the agenda or slash the names of the speaker, so I'm going to pass it on to Susan. If you have any questions, feel free to ask or save for later. Just one quick update would be Crystal from the Health and Human Services has time limitations. So if you have any questions for her, feel free to ask right away. And everybody else, if you want to wait until the end of the program for the Q&A session, that would be great. Susan?
Thank you very much. Good evening, everybody. I'm Sue Caratanuti, Executive Director, Rocky Hill Housing Authority. We have Ken Goldberg, Chairperson, Board of Commissioners of Rocky Hill Housing Authority. So most of you, I'm gathering, know who we are or where we are. But who does not know anything about the Rocky Hill Housing Authority? Wow. Hey, you cheated. We are older adult and disabled affordable housing. Anybody over the age of 62 or anybody over the age of 18 with a certified disability. So I'm going to give you a little bit of Housing 101. The Willow Road complex has 40 units and it was built in 1977. And I'll talk a little bit more about that when we get into the grant portion of this chit chat. And the Harold J. Murphy apartments are up near Mosier School, and they have 30 apartments, and they were built in 1988. So each complex has a community room with laundry facilities. We just updated Harold J. Murphy, not by choice because we had a huge flood. And there's there's a bunch of laundry, there's kitchen facilities. People can meet there if they have friends or, can't fit in their apartment. And then on Willow Road, we have a community building that we just got a huge delivery, and Daya was privy to that. It's under another grant, the HARP grant through CHAFA, and we're starting all kinds of programs. Daya's a part of the Tenant Participation Committee, and so we're scheduling Computer 101. We're doing social gatherings. We have one of our oldest tenants who's been with us forever. Does anybody want to guess what her landmark birthday is next Friday? Just any guess.
80?
Close. It's got 3 digits in it.
Oh my God.
Yeah.
Really?
We're celebrating her 100th birthday. So we're trying to get WFSB down and do a little segment on her because that is just awesome.
That's amazing. That deserves a round of applause.
Yeah. So we're really excited about that. So anyways, the Housing Authority is comprised of the executive director, which I take care of all the day-to-day operations, a big part of the grants. We have a maintenance person who takes care of the grounds. We actually have people that, painters and things that we can pull in because he can only do, we call him MacGyver, but he can only do one thing at a time. And he gets pulled in a million different directions. And then we have the Board of Commissioners who serve as oversight for all the policies and procedures and ensuring that we're in compliant with all the state guidelines and the federal guidelines. And we also have a tenant commissioner who is an actual tenant who lives there, and he's there on behalf of the residents and tenants' perspective. So he's a great asset to our board. So PHAs, What does that stand for? Public housing authorities. That's what we're considered. We are a public corporate political entity. We're responsible for managing and operating housing programs for low-income residents. And we're under Connecticut General Statutes 8-40. If you guys have some spare time and you feel like reading 5,000 pages, have a party over there. The rental income that we generate is our budget. So I was talking to Tom earlier, and we were going through a lot. We have a lot of people that are grandfathered in, and those people are paying a small minimal amount based on their income. But over the years, due to having it for sustainability in our day-to-day operations, that had to change, and we had to increase the base rent. So what we do is, because we don't have a lot of extra finances, we have to do grants all the time. And we are in the middle of 4 different grants. So it's been a lot of paperwork, but it's been worth it. The consolidated grant is a combination with CHAFA, the town of Rocky Hill. Let me back up. It's CDBG, Community Development Block Grant. And that is a federal grant. And this is the 3rd one we've done. We've done both complexes, and now we're back at it. But maximum we'd get on a federal level was $2 million. And how far do you think that takes us with 40 units or 30 units? Last grant we did, we didn't get the back doors because they ran out of money. So this consolidated application is a combination through CHAFA funds, and which we're working diligently to get $3.8 million through the state of Connecticut in combination with the $2 million to perform renovations at the Willow Road site. We need major TLC down there. So we are getting a huge makeover, and hopefully we'll have some kind of soiree at the end when we're completed. And it'll, you guys are all invited. And we've partnered with Department of Housing, CHAFA, and the town of Rocky Hill consistently over the years. We've done small grants with CHAFA during COVID to start a food pantry. We've done grants for resident socialization, and we're working on that right now. We have, there's so many of them, educational grants, and which our rock star over there is going to do Computer 101. And we also had to do grants to make necessary updates because times are changing, and although we're grandfathered in with the handicap accessible units, during this consolidated application, we're going to totally renovate 4 of the handicap accessible units to get up to code, and we're adding 4 more handicap accessible units. Now, every apartment is accessible. We put ramps if somebody needs it, if somebody's living there, and then, their physical limitations have changed. We'll put grab bars in, things like that. And we try to get together. We have Christmas parties and picnics. So it's kind of like a small family down there. State Rep Carrie Wood is our hero. She has been our #1 fan since for a long, long time. And so she collects food. She does huge, food drives for us in collaboration with the fire department. And she also raised money during COVID to buy us a generator for School Street, because we have people, when they lose power, they would have to come down to the only generator we had on Willow Road. So she raised enough money, and we bought a generator for School Street. Diabetics need to store their medicine. People need to plug in their oxygen tanks. But in this new grant for Willow Road, every building is set to get a generator. So you'll never be in the dark down there. So how do we calculate rents? Fun times. When I started many, many years ago, somebody only had to pay $80 to get in there. And we're like, okay, times have changed. I don't think we could pay the electric bill. I don't know how we're going to pay the water bill. So we work diligently with Chaffa. I'm sorry if I keep pulling you in,
No,
but you guys
please
are
do.
rock stars.
Thank you. Wow.
And we integrated something called rental stratification, so that everybody that lived there would still go on their base rent. And every year we do recertifications, and it's based on the last year's income. And if they have a medical deduction, anything they pay out of pocket, we can deduct it in the calculation sheets. But as years passed, we had to increase the base rents. So a lot of people didn't like it. But I think it's still a pretty good gig for people who are struggling or low income. So HUD outlines 3 different income categories: extremely low, very low, and low income. So basically, it's 80% of the AMI, which is area median income. So looking at our area in Rocky Hill, it's a lot higher, you guys, than if you went to a bigger city like Hartford. The guidelines are totally different. And I made copies of the 2025 guidelines. I left them on the table over there if you guys want to pick them up too. So basically, a single person as of April 2025 can make a little under $71,000 and still live there. But you got to remember, your income is your rent is based on your income. And then a couple, we only have 1 bedrooms, and you have no idea how many calls I get. I want a 3-bedroom, I want a jacuzzi, but but we have, it's called the double. It accommodates 2 people, and it's bigger square footage. And so we have doubles and singles. So if you're a couple cohabitating, whatever the case may be, you can make, between the 2 of you, over $81,000. So I don't know if you know this, and it's the next slide, but we do have a cute little website. You're able to go on there, look at all the guidelines. There's checklists. There's frequently asked questions. You can actually fill out the application right online. So we just ask for verification of income and assets. We ask that every year during the recertification process. We need copies if you have IRAs and CDs and annuities. We do not factor in something that's not tangible. If somebody had a regular checking account and they had $100,000 in there, that could be included in your income. But if they have $100,000 in an IRA, it's called an imputed asset, in which we only look at the interest. So unfortunately, we have to do some background checks and credit checks and landlord checks. So it is a long process, but we try to flip the apartments pretty quick. So it's usually in about a month or so that we flip, do the backgrounds, things like that. And again, due to sustainability, as of January 1st, 2025, we had to increase the base rent to $650 and 32% of your annual income. So, because again, we're not getting federal funds, we're not getting, we get the grants, but we're only allowed to use them for renovations. So again, this is our budget. This is how we roll. This is how we pay all the bills. So opening and closing of the waiting list, usually every 3 months. And we usually post it. We have a little Facebook page. If you look up Rocky Hill Housing Authority, and you can also find us on our website, which is https://rhctha.org. And again, you can complete the application on there and ask lots of questions, and you have the capability of sending an email to myself, and it goes to my email at work. So in a nutshell, I know I gave you a lot of info, That's about it. That's how we roll. So we're not doing questions now, or are we waiting until?
Sure, we can do questions now, or if you have questions at a later time.
Okay. Does anybody have any questions now before I hand the reins over?
Oh, that was great.
No. Well, thank you guys so much. Kenny, did you
Thank
have
you.
anything? No? You want to add anything?
That's very good.
Thank you.
Well, thank you, Susan. So it's very informative. Next up, I can call upon Crystal from Human Services. She's going to talk about the renter's rebate.
Hello, my name is Crystal Philbrick. I am the Human Service Specialist here for the town of Rocky Hill. Tonight I'm going to talk about a really important program that we facilitate, and that is rent rebate. So rent rebate is the Connecticut rebate program that is state-funded initiative that provides financial assistance to low-income renters who are either elderly or totally disabled. The program offers a partial reimbursement for rent and utility expenses, is administered at the local level by municipalities, including the town of Rocky Hill. Eligible residents must meet a specific income and residency requirement. So those requirements are as follows. First, you'll need proof of age, verification that you'll be 65 or older by December 31st, 2024 for this current year. So you will have had to have turned 65 by then in order to receive it for this year. Or your spouse who is domiciled with the renter has reached the age of 65 or over at the close of the preceding calendar year. Your Social Security income, you have to show that proof for 2024 with your 1099 form. Or your disability status, you would need documentation from either Social Security or the VA to be applicable. Other income would include things like wages, any additional income, pensions, interest, or dividends. You'd have to show proof of that, as well as if you filed your taxes for 2024, we would need a signed copy of that. Residency, we need proof of residency for at least 1 year prior to the application, and that's anywhere in Connecticut. It doesn't have to be the town that you're applying in. And rental payments, either your lease agreement or rental receipts for all of 2024, or we can take a rental ledger, which we receive often from the Housing Authority. Utility bills, we would need a complete record of 2024 utility bills, electric, gas, oil, water. They're all important because they can count towards your partial reimbursement. So what are the qualifications for this program? So to qualify, like I said, applicants must be 65 or older or receive permanent total disability benefits as defined by the Social Security and meet established income guidelines. They change every year. Be a current resident of Connecticut actively renting at the time of application and have resided in Connecticut for at least a year prior to applying. You can be in a different state once you receive the check. I've had clients who leave shortly after applying for the year previously, and then we send the check to Florida if they're ready to move elsewhere. How to apply. So in order to apply, renters must bring in all the required documentation that we just discussed. Applications cannot, unfortunately, be submitted independently, which means you cannot go online and do this yourself. It has to be done through a municipality or a designated staff member. And in each town, they'll assist the resident by putting it into the online portal. Each town has their own login to this online portal called OPM, and then we can put it in and immediately receive your grant information. So once all that information is entered into the system, your eligibility status and your estimated grant amount are provided immediately. So the great news is when you come in and see me and I put in all your information, I'm going to be able to tell you that day what your approximate grant is going to be. It's always approximate because the state of Connecticut never knows how many people are going to apply to the program, and the funds are distributed accordingly. So usually it's within a few percent of what we tell you in our office. If we say your grant is going to be 700, it can be anywhere from 680 to 720, depending on how many people applied that year. Important dates to remember when it comes to this program is your first day to apply is April 1st. The last day to apply is September 30th. And the checks are mailed out November 30th, which is a change from the previous year. In years past, it's gone out October 30th. As of now, they send them out for November 30th. I like to think it's a nice little chunk of change for right around the holidays for whatever you need to do with it. So that's all I have. Any questions I can answer about the rent rebate program? Yes.
If I may, you're stating that proof of Connecticut residency,
Yes.
so the year prior, I'm sorry.
Yes. I can hear you.
Okay, so proof of Connecticut residency, and it's the year prior.
Yes. It can be a 2024 lease. It can be
Where in Connecticut?
anywhere in Connecticut. As-
I live in,
So let me
okay,
rephrase that. You can have lived anywhere in Connecticut. You have to apply the town you're currently living in. Make sure that's perfectly clear. So say I have a Rocky Hill resident who's only lived here for 2 months. That's fine. They would just need to show the residency for the other months. I can still input it into the system as long as it was in Connecticut. I'm not sure
Okay,
that answers your
That I
question.
think was the clarification. It appeared as if I didn't have to be here. Or
Yes,
I didn't
you have to
live in Rocky Hill.
You have to live in Rocky Hill at the time of the application, but could have lived elsewhere prior,
Okay,
but only in Connecticut.
okay.
Okay. Any other questions? Yes. So for couples, it's $900, and for a single, it's $700. And usually the lowest grant amount. One time for the year, yes. And usually the lowest amount is a $150 grant. So. Any other questions? Nope. Awesome.
Thank you.
Thank you.
Thank you.
Well, thank you so much, Crystal. So next up, we have Brian from CHFA. Brian?
Perfect. Thank you very much for that intro. And thanks to the town of Rocky Hill for putting on this event today. So yes, I am Brian Boyaggi. I'm the Business Development Officer with the Connecticut Housing Finance Authority. And as Sue mentioned earlier, we do a lot to help finance affordable apartments throughout the state of Connecticut. And I'm so happy to hear that we've had such great success here in Rocky Hill. We are a self-funded, for the most part, and quasi-public organization dedicated to alleviating the shortage of housing throughout the state of Connecticut for low to moderate income borrowers and families. And since 1969, we've actually helped more than 6,000 affordable apartments be built statewide. And I'm on the home ownership side of things. So what I predominantly deal with is mortgages and helping people become first-time home buyers and move from renting to home ownership and building that generational wealth. And since 1969, we've actually helped over 150,000 families purchase their first home, which is something we're extremely proud of. And last year, despite the real estate market being a bit of a challenging scenario for most, with lack of inventory, higher prices, inflation, we actually had a banner year at CHFA. We ended up closing over 3,800 mortgages, helping people get that first home, and we financed over $1 billion in mortgage funds in 150 towns out of 169 throughout the state of Connecticut. So we're really, really proud of that. Now, by the way, today I'm doing a condensed presentation. Normally our presentation's about 25 minutes, so to fit the time constraints, I'm kind of squeezing it into about 10, but I'll be happy to answer any questions afterwards. So what makes CHFA different and special? There's kind of 4 pillars we're built on. The first one is that we, with again, being self-funded for the most part, our first mortgages, we generate the funds through mortgage revenue bonds. And those bonds we can offer at a lower rate because of the tax advantages to the end user. We then turn around with that low rate funding and issue it on our mortgages. So no matter what the market's doing, our rates tend to be lower than those of a traditional bank's mortgage that isn't helped by CHFA. So we have lower rates, and we also set the closing costs on those programs, which is very helpful. We have income limits and sales price limits. Again, our focus is to help the low to moderate income families in the state of Connecticut. We have down payment assistance programs. Now, that's probably the biggest pillar that everyone's talking about lately, especially with just the challenges that are out there with the higher rent, inflation, higher cost of living. It's harder and harder for Americans to save money for that down payment. We've had one down payment assistance program for many, many years, and about 3 years ago, the state of Connecticut and the Department of Housing worked with us to develop another one, which I'll get into later. But those are having a huge impact on helping people get that first home. And then the last thing that we're huge proponents of and proud of is that we help sponsor free homebuyer education for all of our home buyers. We work with about 12 different HUD-approved counseling agencies in Connecticut, and we really believe that education is power, and we want to help people understand the process and empower themselves to move into home ownership. So at CHFA, how do we define a first-time home buyer? There's two definitions, really. One is the obvious one. One is somebody who's never, ever owned a house before. They would qualify, obviously, as a first-time buyer. The second one is a little different. If you once owned a home, and then you decided not to own your primary residence anymore, and 3 years have passed since you've owned a primary residence, we will consider you a first-time home buyer yet again, and you'll qualify for all the benefits that CHFA has to offer. Okay, so actually I have some really good news. This is a slide I submitted last week because I had to kind of get ahead of the curve and get everything ready. But our rate today dropped to 6.125% on our FHA and VA and USDA mortgages. Also, our conventional mortgage rate also dropped from 6.625 to 6.5. So our rates are highly, highly competitive, which is great. We also have no points on our mortgages, which is huge. So if you have credit scores that aren't quite ideal, or you're putting a lower amount down, or you're buying, let's say, a multifamily house or a condominium, there's no extra add-on points that you typically see with a traditional mortgage. Now, eligibility requirements. The borrower's income has to be at or below that CHFA income limit that we set, and they have to buy a home that's under the CHFA sales price limits. I'll get into those in a moment. The borrower has to agree to live in their house as their primary residence. Our mission is to help people get that first home, that primary residence. So we're not in the business to help finance vacation homes or investment properties, rental properties. Our focus is truly on helping people get their primary residence. So these are the income limits. You can find them on our website, chfa.org. And they're broken down by county and even by town and then by household size. So I kind of highlighted here on this slide Rocky Hill, being that that's where we're focusing tonight. And in Rocky Hill, if you're a household size, so residents living in the house, not just borrowers, household size of 1 or 2 people, the income limit is $122,300. However, if there's more than 3 people, 3 or more people living in the house, could be children, elderly relatives, then the income limit increases to $140,645. So if your income is fitting that range, you would, from an income standpoint, qualify for CHFA. Now, here's our sales price limit. So everywhere in Harford County, including Rocky Hill, the sales price limit is $537,360. We do adjust these every year based on what the IRS and the Treasury and HUD give us for data. We follow their lead on it, and there's a QR code too if you want to use that to go right to the website. But again, chfa.org. If you go to our website, you can find all this valuable information. Now getting into the down payment assistance. This is kind of really what is empowering so many people lately to get that first home. This is a program, pretty straightforward with the name, Down Payment Assistance, DAP we call it. And what is it? It is something that you can use in conjunction with a CHFA first mortgage to get the funding you need for down payment and closing costs. Many times when you qualify for a mortgage, you might qualify for a mortgage that needs a 3% down payment or a 3.5% down payment. This program, when used with one of our CHFA mortgages, is up to $15,000. It's at a fixed rate of 5%, so it's at a below market interest rate. fixed for 30 years, and it could be up to $15,000 or up to 4% of the sales price, whichever is lower. And this is something we've had for many, many years, and it's been highly successful. And I'm really proud of this. This follows our traditional income limits that I just reviewed with you. Then we have this, time to own, which has been getting a lot of attention, especially in the local media. It's coming up on its 3rd-year anniversary. So in June of 2022, we worked with the Department of Housing. They are the ones who created the program, thankfully with funding from the state of Connecticut, from the governor. Thankfully, it's bipartisan. Both sides of the aisle seem to really support this and understand how important homeownership is. But what it is this. You use it in conjunction with a CHFA First Mortgage. It's up to $25,000 towards your down payment and closing costs. It is at 0%. So there is a 0% interest rate and there's no monthly payments. And it gets even better than that, if you can believe it. Every year on the anniversary date of that home purchase, 10% of the principal balance of that time-to-own mortgage at 0% is forgiven. So let's say you do qualify for the full $25,000. Every year on the anniversary date of the purchase of your home, $2,500 will be forgiven. And at the end of 10 years, it's fully forgiven. The only way you'd ever have to pay back a prorated portion of it is if you sold the house or refinanced it within the first 10 years. At that point, whatever's remaining based on, that's unforgiven would be paid back. But it could be used for up to 20% of your down payment. It could be used for up to 5% of your closing costs. There are a few different caveats with it. The borrower does have to show that he or she was a Connecticut, or both were Connecticut residents for at least 3 years or longer. Again, this is money that is being supported from the state of Connecticut, so they want to make sure that we're rewarding those that have been residents of the state for 3 years or more. Another really interesting component is that this can be combined, so you get our CHFA First Mortgage, you get time to own. If there's other municipal programs out there for down payment assistance or other organizations that are willing to give support for down payment assistance, this doesn't have to be in the second lien position. So you can combine our CHFA First Mortgage and time to own with other resources that are out there. And we've had mortgages that are combined with multiple sources, some up to like 7 sources of down payment assistance to help maximize the benefits that borrower qualifies for, which is really exciting. So if you go to our website, again, chfa.org, bit of a broken record there, but I love our website. You'll see what we have left. And right now, if you go to it, you would see, this is actually from last week, but we're about $39,800,000 remaining in time to own. It is a limited time only program, and once the funds are gone, in theory, then the program would be paused. Now, we're coming up on that time of the year, if you guys follow state politics, where every 2 years they come up with a new 2-year budget. And the last 2-year budget they drafted was around this time in 2023. So the new budget will be discussed, and it's in discussion right now, and it'll go into effect July 1st of this year. And whenever I've looked up news on where time to own stands as a possible piece of their budget, I did see that the governor has suggested $100 million more be added to this. Now, of course, that has to be negotiated amongst those on Capitol Hill. But again, it seems like this program has a lot of support from both sides of the aisle. So just kind of keep watching your news and maybe reach out to your local representative or state senator and let them know how much you love this time to own program. And hopefully you'll be reading in the new 2-year budget, again, effective this July 1st, that more money will be added to time to own, which would be great. This is the income limit for time to own, highlighting Harford County again. So it's a little different because this is a needs-based program. So those that are earning 80% of the area median income or lower would qualify for the whole $25,000. So in Harford County, Rocky Hill, $97,920. If the borrower's income is that or lower, then from an income standpoint, they would qualify for the whole $25,000 for time to own. If they're earning more than that, but less than 100% area median income, which is $122,400. So if they're earning somewhere in between, they still qualify for time to own. It would just be a lower amount. It would be 75% of the $25,000, which would be $18,750. If the borrowers earn more than 100% area median income, then again, needs-based program, they would not qualify for time to own. But they could certainly look again at that DAP program we just talked about, because that uses our higher traditional income limits. Our website has all of the lenders we work with. We work with close to 90 lenders. So when you apply for a Chaffa mortgage, you're actually going to work with one of our participating lenders. All of our lenders have brick and mortar offices and locations in Connecticut. That's a mandate that we have. But you can go to our website, check out the list of lenders, and you can reach out to them. Chaffa does set the interest rate and the terms of our mortgages. So if you call different lenders, they're all going to offer you that same Chaffa rate on that same given day, which is kind of cool that Chaffa controls that rate, and you don't have to worry about shopping around too much. Happy to see that two of our lenders are actually in the room today. We have Liberty and Washington Trust. Both are excellent Chaffa lenders, and we appreciate the partnership that we have with them. And again, our website has over 90 lenders, or about 90 lenders that we do work with in the state. Where do you start if you are interested in becoming a Chaffa borrower? Well, you go to our website, chfa.org, and you'll find our first-time homebuyer guide. With the 8 steps to being a first-time homebuyer, the first step we always say is get that homebuyer education. We have 12 different HUD-approved counseling agencies. Chaffa pays for that education for the borrower, so we help support that. So definitely check it out. The second step we always recommend is that the borrower get pre-approved for a mortgage. Talk to one of our participating lenders. Get qualified. Get a pre-approval from them for this mortgage. Let them know that you're interested in CHFA. If you speak to a lender that doesn't offer Chaffa, they're not going to discuss our program. So make sure you go to our website and check out that list. We have some great stats here on how many people we actually helped last year, again, being a banner year for us. Over 5,700 people got our home buyer and homeowner educational workshops. We had one-on-one counseling for over 1,700 people. And then we also help people that own a home with foreclosure prevention, 511 of those. And then we have something new called financial fitness workshops, which 637 took a part in. You don't have to be ready, by the way, right now to take part in our free homebuyer education. You can, that's the whole point, is if you're not looking for a house right now, but let's say this is a goal in a year or two, you could still talk to one of our counselors right now and get that education, lay the foundation for understanding the process for the future. And there's a calendar on our website where you can see, this is just a 2-week snippet, but you can see all the different courses that are available. They're available in person with our counseling agencies, online with our counseling agencies, and some are even offered in Spanish if that's your language that you prefer to learn in. But lots and lots of different options for getting that education. And that's all I have for right now. And I'll be happy to take any questions as well if you have some. I see one in the back.
Brian, I have 2 quick questions.
Sure.
Are all your mortgages fixed rate?
Yes, all of our CHFA mortgages, the first mortgages, are 30-year fixed-rate mortgages. No adjustable rate mortgages or different terms like a 15. They're all 30-year fixed rate.
Can the applicant get part of their down payment as a gift from a close relative?
Absolutely. So we follow agency guidelines. So if they're obtaining an FHA or a conventional mortgage, let's say, they would follow those agency guidelines with their approved lender. But yeah, many of our borrowers do benefit from getting a gift from family members to help qualify for the mortgage.
Thank you.
You got it. Any other questions? Sure, Alan.
In the past, you had different levels of dollar amounts for time to own, and I think it was maybe they removed the higher amount to kind of add to the longevity of it. Any talk in the works of bringing the different levels back or anything like that?
Yes. So when Time to Own first came out, there were different levels of the loan for Time to Own, but we realized that we're probably going to help spread the wealth and help more people by having a $25,000 going forward. But you're right, it was a little more complex where we had higher opportunity that were qualified for a little bit more money. Going forward, something that was instituted months ago, how the fund, but it seems like forward that the $5,000 all throughout every Connecticut will probably be the standard.
One other question. You've got a couple ways that people can even lower that interest, whether they work in industry or are moving to certain areas, correct?
Correct. So there you go. So that's part of the presentation that I condensed. But we do have areas where you can qualify, depending on a few different criteria, where you might qualify for like an 1/8 off on the interest rate. We do have a teacher's mortgage assistance program where based on either the subject matter you teach or the district you teach in, you may qualify for 1/8 off on that rate. If you attended a historically Black or Hispanic university, you might qualify for a 1/4 off on that rate. a police program. If you're a police officer and you're buying a house in that you work in, you would qualify for an eighth. Or if you're a state trooper, you can qualify all throughout the state of Connecticut with an eighth. If you had served in the military, present, there's a military homeownership account that qualifies for, again, 125% at interest rate. There's another program for people who have disabilities or a homeowner or a household member with a disability. If it's an ADA recognized disability, you may qualify for an extra eighth off on your interest rate. Now, these can't all be combined. If you have like a teacher with married to a police officer, it's one discount, whatever happens to be the maximum discount. But yes, there are a few different caveats where you can get an even lower rate than that 6.125% rate we talked about today.
And last question, I promise. There's a program, I don't know if it's still going on, related to student loan debt. If you owe a certain amount of student debt, you could call for additional discount as well.
That was called the SMART program, and we did do a pilot of that program where we offer discount on the interest rate if the borrower had over $15,000 student loan debt. It seemed to have an impact, but that was money was allocated from the state. There are discussions possibly about bringing it back, but right now I have no guidance on whether or not that'll certainly come back or not. I know it's a discussion. Again, with all recent operations going on at national level, and since that has a domino effect down here, we can't say with certainty if that program will be reappearing anytime soon. But while that was ill, it did have a nice impact. Yeah. Oh, question in the fourth row.
So I have a question. Are there prepayment restrictions on borrowers taking advantage of, say, time to own or down payment assistance?
Sure.
Any of these programs, are there any prepayment restrictions?
The time to own program is forgivable on a prorated basis. So 10% of that time to own does get forgiven every year. So a borrower could possibly pay a portion of that back, again, with no interest having been accrued, if they were to refinance or pay off that mortgage within the first 10 years. The DAP loan does not have anything of that nature. It's literally just a 30-year mortgage at 5%, whatever the payoff happens to be at the time of sale of the home or refinance, that's the portion that's paid back. And then our mortgages do not get any prepayment penalties. Thankfully, during the Great Recession, those seem to pretty much be eliminated by all banks. Chaffa never had those on our mortgages, but we certainly do not have any prepayment penalties on the 30-year fixed rate mortgages that we offer. But great question. These are great questions, by the way. Anybody else? Okay. I guess I'm all set.
Yeah.
Thank you, bro. That was very informative. So next up we have Washington Trust. We have Michelle.
We're going to do a duo.
All right. Some teamwork coming
Thank you. Thank you so much.
Thank you, Vin, for this. It was very informative. Brian, that was awesome.
Oh, thank you so much.
Very good. We partnership with them as well. My name is Sarnisi. I'm a vice president with the Washington Trust, and my goal here, more or less before Michelle takes over, is just to give information of who we are. The Washington Trust is the largest community bank in the country, 220-plus-year-old, located in Westerly, Rhode Island. About 15 years ago, Washington Trust looked to expand its operation into further parts of New England, and they chose basically the Glastonbury area, which is where our local office is, to be able to supply these local communities with products that we can offer as well. So what we wanted to bring was a very local feel from our company to be able to assist using a lot of the products that have been talked about here tonight. So Michelle's going to, my boss, is going to dive in, some of these products that we offer, which do mirror a little bit. Everyone else probably will be talking about as well, but more or less to make sure we can offer the same type of sense that everyone here is looking to communities. Thank you for having us again. It's been very informative. I've been a lot myself sitting and listening to these expo. It's yours. Thank you.
Good evening, everybody. Thank you. Yes, thank you for inviting us. We're here tonight to talk about the path to home ownership in a couple different ways. The slide is very comprehensive, but I'm going to kind of move over it. I believe it'll be living on the site, so you guys can refer back to it. At Washington Trust, what we value is the client in every community. We really take pride in putting people into homes. We offer various programs and products, but we'll just get into the agenda a little bit. All right, am I working this right, Steve? There we go. Tonight, we're going to talk about the difference between buying and renting, understand the meaning of the word mortgage, understand how to obtain a mortgage, the different types of programs, like I talked about, what you need to close on a mortgage. It's one thing to get a mortgage, it's a whole other thing talking about the closing, and then learning how to protect your home once you own it. I'm just going to kind of go over that briefly. So the first thing is credit. Everything starts with credit. And your credit is comprised of your financial history. It could be credit cards, it can be installment loans, it can be auto loans, it could be previous mortgages. You are scored based on your financial history, based on how much you pay or how timely you pay. Very impactful. So if you're looking to purchase a home, one of the first things you want to do is check out your credit. You want to kind of know. And if you go to a loan advisor, you get your loan officer, you have your credit pulled, you want to go over that. You want to make sure that everything on there is true and accurate. If there's any discrepancies, you want to clean that up before you proceed. But that is a big part of purchasing a home. It drives just about everything. It drives your program, it drives your interest rate, it drives everything. So just be conscious of that. Buying versus renting. I'm just going to kind of go over this quickly. The advantages of buying is you build equity and you increase value in your home. You have a sense of community, stability. A lot of people strive to be a homeowner. And then there's renting advantages, little or no responsibility, and it's easier to move. Some people, home ownership doesn't work for everybody. It's really based on your personal preference. Buying considerations, you're now responsible for the maintenance of the home, the taxes, the possibility of loss or equity, and it's less mobile, right? You have to be able to market it, has to be marketable, you have to sell it. Renting considerations, there's no tax benefit, there's no equity building, so you're not building on your financial portfolio. There's no control over your rent increase and the possibility of eviction. So, there's many programs out there today that bring a renter into buying that weren't available. CHFA being one of them, as Brian talked about. We do a lot of CHFA. So there's many programs today, but again, it's personal preference. So mortgage pre-qual. When you are looking to get a mortgage, the first thing you need to do is get pre-qualified. And what pre-qualification does is it looks at your credit, which we already talked about, and your income. How is your income derived? Are you hourly? Are you salary? All these things matter, and they come into play. There is never a silly question tonight or after you've thought about things. Education is key. Understanding the process and understanding what we're asking of you and why is so important. Never, never, never not ask a question. I tell people that all the time. Typically, you'll need to provide your income verification. That can be by way of your tax returns or your pay stubs. We want your most recent so we can kind of verify that. Your asset statements, whether it's your savings, your checking, or your retirement, and then we'll pull credit typically, but if we're not pulling credit, a list of what you have for debt. So we can get a general idea of how much your income is versus your debt. It's called debt to income ratio, and that's gonna, again, plays a big part and a role in what we can and can't put you in. These are I'm just going to go over this really quickly. This is what is comprised in a mortgage payment. A mortgage payment is your principal and interest. It is the taxes of your home, which are, those are outside of our control. It is the homeowner's insurance policy that you get. And if private mortgage insurance is required, that is an additional component to your payment. So this slide right here kind of gives a breakdown of what that looks like. There are a couple different types of mortgages. We talked about with CHFA, the 30-year fixed. That is a fixed rate for the life of the loan. So if you were to life out your mortgage for 30 years, your rate would never change. There is an adjustable rate option, which means for a specific period of time, your interest rate is the same, and then it changes. It changes based on your caps and your margins, so what's ever going on in the market at that time, it can adjust. Both options are great. People use them for different reasons. It depends on their personal scenario. Just some of the first-time home buyers products that we offer. Fannie Mae is got a Home Ready. Freddie Mac is Home Possible, CHFA we talked about. FHA and USDA. These are all great programs with low down payments or no down payments depending on your qualifications. Ooh, and I just shut this off. Oh, it's back. Okay. Down payment requirements, it could be 0 to 3% depending on the program, whether we're working with CHAFA or we're working with an agency loan. If you want to avoid the private mortgage insurance, you can put 20% down. We talked about down payment assistance, we talked about gifts. There's a lot of different ways in which you can come up with a down payment. It is best to talk to your loan advisor, tell them everything, you kind of lay it out on the table, and our job is to advise you as to the best scenarios possible with what you've presented. And ultimately, you are the boss, you make those decisions, our job is to educate you. Next one is cash to close. We're just going to kind of quickly go over that. You know, you've pre-qualified, you're doing everything, you're thinking about your down payment, but there is closing cost. There's closing costs with every loan. Some are, you can roll them in, some generally you can't, so you need to budget for your down payment as well as your closing cost. And we'll just let that go. Really quickly, loan process. So you walk through the door, you talk to Stephen, you get pre-qualified for a mortgage. You have found a house, you've gone under contract, and so now the cycle of the loan, it goes into underwriting, it goes into closing, it goes through processing. So it has this flow that happens to it, and at different times of different milestones, different things happen. You apply, you get disclosures, and then we order an appraisal. An appraiser goes out there, he gives the value of the home. We want it to match the contract. Then the file goes to an underwriter. That underwriter is going to look at the appraisal. She's going to look at your credit, and she's going to look at your income as a whole and make that decision. And that kind of happens there, and then you go to closing. So there is a little bit of a flow to it. We talked about that. And talk to a professional, like we all talked about tonight. It is so important to talk to somebody who has your best interest, who knows all the background and can guide you, whether it's on your credit, your income, or programs, or give you resources. It's vital to do that. And then this is for when you already own your home. I'm just going to pass over this. This is 5 ways to protect yourself from foreclosure. It's a big thing. You know, you don't want to just ignore your mortgage payments or, you know, not do your homework by talking to a counselor. There's a lot of programs out there that help and have resources for, you know, if you get into trouble with your mortgage payments. So, and that is a wrap. Yes. Does anybody have any questions? In the back.
I have 2 questions that relate to the phenomenon in the market that we're seeing. Rocky Hill is still in demand.
Mm-hmm.
If you look out the window, you see Washington Street, and a house went on the market 10 days ago. And there was an asking price. And according to Alan, there was a huge volume. Let's say there were 150 people went through, and people bid the house up. Okay, so the first question has to do with appraisal. If someone comes to you, get pre-qualified, you talk about things, and they see this house and they say, oh great, it's in my price range, and talk to you about a mortgage and so on. But at the end of the 7 days, they're at 120% of the asking price. How do you deal with that in a rising value marketplace? To have an appraisal that you as the lender feel comfortable dealing with?
Great question, because actually a very huge topic now. What we're seeing is, to your point, a lot of strategy where real estate agents may be supporting a lower price to start the housing bids, and bids continue to get higher and higher and higher. We're seeing situations where people are going into contract, waiving appraisals in the sense that they're trying to make their offer more appealing so that the appraisal value doesn't have an impact. From our standpoint, obviously, we need the appraisal to be consistent with the purchase price of the home. Hopefully, there are enough things in place done by the real estate community to support that, knowing that if this house does sell for whatever price, that appraiser is going to be able to support that value. So it has a challenge, because there are people that are starting out for the first time that have been qualified for a certain price. They find that house that's in that price range, and next thing you know, that price range is higher and higher. So it then takes them out of that range. Fortunately, sometimes the list price of a home may be where that house is gonna end up. It's not like, years ago where maybe the list price here and maybe someone negotiated a great deal and got a better price or a more appealing price. It's kind of going the other way. So right, the offers have been so different with people that are coming to the table where they're willing to waive all of these inspections, and therefore, from a mortgage standpoint, they're getting, they're accepting whatever the values may be, and are prepared to pay more than what the appraisal may be supporting.
And do you sell your loans to a larger entity? In the old days, it used to be if, let's say, it was New Haven Savings, if anybody remembers that, they would hold their mortgages, or they would make an arrangement if someone would say, all right, the seller's going to give a second mortgage for the gap that you're not going to finance, or, all kinds of crazy things. So are you constrained by not necessarily your own corporate underwriting, but to whom you're going to sell them?
No,
No.
I think the one thing that we have at the Washington Trust, which is a little bit of a niche, we are a large portfolio lender to coincide an agency lender. So what that means is that, to your first part of the question, loans that we deal on a more regular basis are backed and supported through the agencies Fannie Mae and Freddie Mac. So you are following those guidelines, as our partners do as well for the most part. And so you don't have a lot of flexibility in what you can and can't do outside of those. Being a portfolio lender is where us at the Washington Trust have a bucket of money that belongs to the bank that we are able to make decisions on based on the strength or the profile of the client. So in those cases, we have our own under criteria. So generally, if someone's outside the box of a standard traditional loan, we'll have the ability to look at that and make a decision based on other strengths of that client. So that's when we may have the situation like you're saying that we would look at and say, we're okay with that. It may not be a loan to go this way, but it's a loan we're comfortable with for reasons. So today's industry does allow a little bit of give and take depending on if the bank can those types of
Last question. I know someone was helping a divorced child purchase a home in Westfield. Similar situation, house available at the lower end of the cost range, and a lot of bidders on the house, and the people that we knew wanted to have an inspection as a condition of the purchase contract, and there were other people who did not have that. You as a lender, do you take a position on whether or not the buyer has a property inspection?
We don't require it.
We don't require it. Generally, if there's any issues that are really going to be property driven, that's where the appraisal would come in. So if the appraiser is making any sort of commentary or pointing out things with the property that could concern us, that's what we're driving off of. And the only thing that I would kind of, again, to your point of people looking is, unfortunately, when we're talking about all this great product options for first-time home buyers, unfortunately, what we're seeing in some cases is the first-time home buyers getting almost knocked out because there's so many people out there that have the ability financially to pay cash or to waive these inspections because they're comfortable with how they can afford this home or
pay above the ask
or
price.
pay above the ask price because they. So we're in a little bit of that turmoil where all these fantastic programs that everyone has to help our first-time home buyers and help the community, we're up against very different obstacles that are beyond the financing part. So unfortunately, that's what we're dealing with now is many well-qualified first-time young couples that are just getting frustrated because every time they find the house of their dreams, unfortunately, someone paid $50,000 more, and these people unfortunately can't financially do that. So it's move on to the next and just see, hopefully falls in their laps. So, thank you.
Thank you. Oh.
No, question.
So a situation where your appraised value is, thank you. In a situation where appraised value of a home, that you through your underwriting process would come up with is lower than the contract value that your client, and he's willing to put in cash for that difference. The fact that someone's putting in so much more money than the appraised value, it affect the interest rate that,
No.
he would pay otherwise if the appraised value came in line with the assessed value.
Our lending is going to go off the appraised value. So if the client has the means to pay that difference, the gap, that's up to them. We're going to factor that in. But everything we're looking at from that file is the appraised value and the sale contract, the lesser of the, and that's where our numbers come down off our down payment and our FICO scores and where we derive our interest rate. So no.
Thank you.
Yes, you may.
The Affordable Housing Board is looking at tiny homes for our community. Would that be an acceptable residence to receive a loan?
It could in a portfolio.
Yes.
But when you speak about affordable housing, I don't think about 20% down, right? And our portfolio products, which are outside of agency guidelines, or there's a reason why, typically require 20% down. We do have programs that are 10% down. We do the 10% second, like you were talking about, other places coming in and doing that second to make up the difference. But it could be a consideration. It's going to have to be a trend. We'd wave our hand and say, yes, let's be the first ones out. But I would like to think that we would jump at an opportunity to pull into homes.
What would this, just because not,
Right now, the state is looking at 100 square feet.
Trying to think.
so it'd be one unit at 400 square feet.
Right, to be considered a tiny home, it can exceed 400 square feet.
Okay. Is there a minimum? In other words, 400 is the max. Okay.
Actually, we could get back to you on that. We'd have guidelines and see, you'd have to meet agency guidelines. And I know in time, I thought it was a minimum square for agency. I don't off the top of my head, but if it met all the other perimeters, it had the heat, it had the water, it had, around agency and everything else that I don't see why there would be a reason it couldn't. There's just going to have to be comparables.
There were, and Richie, the town planner, there were court cases years ago that basically said to communities, we have to eliminate the minimum housing size. Years ago.
Okay.
Because we used to have a minimum housing size, we eliminated that years ago.
Okay.
We'll bring that back
Yeah.
and address that, because if it's something that's now becoming popular, I think it's something.
Yeah. Thanks so much for your time. Thank you.
Great job. Very good. Awesome job. You got it.
Thank you, and Steven. I mean, this is great information. I have some more comments. We have Linda from Liberty Bank. You're up next.
Hi, everyone. I'm Linda Urbanik. I'm with Liberty Bank. I'm on the affordable lending team. So what I like to do is I help first-time home buyers. I'm sorry, I don't have a presentation, so I'm just going to speak. I help first-time home buyers with low to mod incomes, with all kinds of grant programs. We partner with CHAFA, HDF, Housing Development Fund, LCI New Haven, House Hartford. So we partner with a lot of agencies, and we can layer up grants. There's no limit with us. I know other banks have maybe they only allow 2 grants, but we'll go up to 6 or 7, 8 grants. It doesn't matter. We don't have a limit on that. So I'm just going to speak on how to, qualify for a mortgage. So there's 3 factors that a lender will look at. Number 1 is credit, as Michelle was speaking about. So we do a hard pull on someone's credit, and we're looking at the 3 FICO scores. So we're gonna look at Experian, Equifax, and TransUnion. We're gonna get the 3 scores, and we're gonna take the middle score. So if someone has a 700, a 675, and a 725, the middle score is 700. That's what we're gonna use to determine an interest rate, if that's applicable, or mortgage insurance. That is, the credit score matters on that too, factor in there. We look at all of the debt, like not only the score, but we need to see, how are the payments being made? Is there a lot of revolving debt? Are there student loans, credit cards, installment loans, a car lease? Anything that's on the credit, we take a look at it. Student loans, I'm always asked this question, so a lot of times they're in deferment right now, but we do have to put a payment in there. So depending on what one they're going into, we're going to either put 1% of the total amount that's due or a 0.5%, depending which way. Or if the borrower can get, if they're going to be repaying soon, they can get an income-driven letter from the student loan company. So if it says they're going to be paying, $43.70 a month, then we will use that payment, as long as the payment's going to start like the following month. It can't be, all right, they're going to start making this payment like next October. We can't use that. We would go back to the 1% or the 0.5%. Auto loans, if they have less than 10 payments left, we don't have to use that. We can exclude that payment. But we use, credit minimum payments on credit cards. So I always let my customers know, like, the more debt you have, the less you're going to be able to borrow on a mortgage. So, and everyone, they get one free report a year at annualcreditreport.com. So you can look on there, and it'll have all of your trade lines and everything shown up there. So that's, credit's number one. It's really, really, really important. The second one is income and employment. So we need to see, what your income is. Are you self-employed? If you are, you have to be doing that for 2 full years. It can't be like a year and 10 months, or we need 2 tax returns showing positive income coming, generated from that business. Are you an hourly employee? Do you work 40 hours a week at X amount an hour? That's fine. Then we use that. But maybe you have variable hours. Maybe some weeks you work 38 hours. Maybe some weeks you work 45 hours. So we'll do an average of the hours worked. If you're on a salary, that is what it is. If you're earning commissions, bonus, overtime, you have to have a 2-year history of doing that. So we would look at, we get a full written verification from your employer showing, they averaged out for the last 2 years. We can use that as income, but you do have to have a 2-year history of showing that kind of income. Pensions can be used. Retired people can also qualify for mortgages with pensions, Social Security, retirement Social Security, disability Social Security, annuities, whatever, investments, that kind of, any of that can be used for income. And so we're looking for a 2-year job history. So you don't necessarily have to be working with the same employer for 2 years, but you have to have that history of the employment. So you just put in like your previous employer if you've only been there 6 months. And it's okay, like if you've been with your current employer 6 months, and then you were with a previous employer for 8 months, and then you were a previous employer for a year. That's all fine. If there's a gap in employment, we want to see, and those are fine too. You just have to write a letter as to why why you were unemployed, whether you got laid off, or maybe you're out on medical leave or maternity leave. Like, all of that stuff is perfectly acceptable as long as you're back back working. So that's pretty much for income and employment. If you are just getting out of college, you do not have to have the 2-year job history. We'll take a copy of your transcripts and your diploma, and so that's fine. And then your offer letter with your new employer. So that's all good. So that's it for the income and employment. And then the third category or factor is assets. So we need to see bank account statements, even though some of these programs you may not have to put any funds down of your own, but the catch with that is, right, if you want to sign a contract, and you have to put a deposit down up front. So all these grant funds and any of the monies doesn't happen till the closing. So you do have to have that upfront deposit. Gift funds from a relative is perfectly acceptable. We look for like large deposits. Any cash deposits, it can't be verified. So everything has to be, like, there has to be a paper trail. It has to be documented and verified. So cash, we can't use that, because it just can't be verified. But gifts, obviously, your income coming in. We look at different. Sometimes we need to see a retirement statement, just if the loan's a little bit shaky, and then just to make you look like a stronger borrower, we can throw in some. They have retirement funds. We generally look at the two recent 60 days of checking and savings. So that's pretty much it for, so it's it is easy to qualify. It's just that you really have to, those are the three factors in qualifying for a mortgage. Anybody have any questions? Yes. Yeah.
What if somebody comes to you and you a microphone? And what if the sale is not completely arm's length a grandparent wants to sell to a grandchild?
Mm-hmm.
I know that you're going to have the appraisal, but what else comes into play in that?
So, Jaffa has to be arm's length, right?
Yes.
Okay.
For time to own, yeah.
Yeah. So what, they can still, if you're buying it from a relative, they can still give like a gift of equity. So let's say the house is, let's say $200,000, right? They can, and let's say the person selling it wants to just net, 180 or whatever. So they can give them a gift of equity for the down payment, and they can also give them a credit for closing costs. So I've done it where literally the buyer, there's no money out of their pocket. We just have to work the numbers so that the seller gets what they want in their pocket. Yeah. So what we would do, unless there's like we get a waiver, what's called a waiver when you run it through automated underwriting, Fannie Mae. Sometimes you get an appraisal waiver. But we most likely would do an appraisal, and then, as long as it praises, then we can figure the numbers out. Yeah. I've done that before. And then the, agents involved, then attorney has to draft up, a simple contract, just stating the terms and, yeah. Yes?
Just following up on that, let's say the value of the house by an independent appraiser is $200,000, and the grandparents are going to, in effect, deed it to the grandchild at, maybe they have to, I don't know, by the IRS, it has some involvement here, I think. Say they deed it over and they only want to borrow from Liberty Bank $100,000. That seems like a no-brainer in effect.
Right.
But is it somehow complicated by the legality of this type of transaction?
No, but so what I always recommend is when this does happen, I always recommend that the seller ask their accountant, because we're not accountants. Like, I can figure out the mortgage part of it, but I don't know what their tax consequences will be, because if there's like a gift of equity or.
Between the lender,
Yeah.
you and the borrower, the grandchild,
Mhm.
whatever the IRS or the person deeding it,
Yeah.
doesn't really matter.
Right, no.
I have a question. If we could just back it up one step, eliminating the idea that, parents are going to hand one down, or that you have 20% down or whatever. Just that but I think you might be the right person to answer this, but anybody else can kick in too. Somebody just says, you know what, I'm tired of renting, I'm spending all this money, I don't have a ton of money in the bank. What kind of credit score do they need to set as like a goal to have to be able to borrow something? And how much should they amass in their bank account to be able to just buy like the bare minimum, small condo, small house, whatever, and take advantage of some of these programs? But there's still, like you said, there's still going to be some costs. You still have to write a deposit. You still may have to pay an inspector, an appraiser, like all these things. So what do you recommend they have?
So if
as a
they're
target
going to
goal?
cover, so a couple things. So, right, if they're going to cover their initial down payment, which has to be put down at time of signing the contract, I think people should at least have $5,000 to cover that. To go back to your credit score requirement, every lender has overlays. So with Liberty Bank, they have to have at least a 620 credit score with us. But we have other programs where they have to have a 660. So depending on like what program they're in, I know other lenders, it could be lower than that.
So like if they have a 620 credit score, they might just have a higher interest rate.
Well,
or
like,
if
so
they
for
have
instance, like,
lower?
if we put it through Chaffa, they don't, this credit score doesn't matter. They're gonna get the same rate, no matter if they have a 620 or an 800. Yeah, yeah. But, so for instance, these other agencies that I work with for, like, Housing Development Fund, they have a Smart Move program where you can borrow the 20% down. It's, it's paid back over 20 years at 3%, which is pretty good, right? But they require like 2 months reserves. There's some other, they want to see a home inspection. So there's other fees, and they have their own fees as well. So we try to roll that all into that. It's not really a grant because they have loan programs. But again, all these funds are not available to the day of the closing. So they do have to come up with that initial deposit, which that could be gift funds too from a relative.
Well, but so you would say,
I always,
generally,
like when I do the first-time homebuyer classes for the different agencies, housing agencies, I recommend that and they do the same, like they recommend like you have at least $5,000 in a savings account.
so if it's starting from scratch, should have $5,000 in the bank and a credit score of like 620 to put themselves in like a position to at least consider trying to outbid somebody and all of that
not
stuff.
a lot of debt, so, you know,
Yes. Yeah.
yeah, not a lot of like, you know, try to like have not, you know, just, and I know, you know, it can't be helped sometimes, but that, unfortunately, that just diminishes how much they can borrow, the more debt they have. So the more they can pay down, they'll qualify.
And then just the last question related to that is a lot of people look at purchasing a multifamily, a small multifamily, like a duplex or something like that as an option to be able to qualify, you know, to be able to cover more of the mortgage themselves. Can you talk about how that might factor in, you know, what might be a little bit different with that?
So multifamilies are a little bit tricky because if they're using a conventional loan product, they have to have 6 months reserves, and that means 6 months mortgage payments on hand. And a lot of these first-time homebuyers, they don't have that money. So a two-family, we could put them FHA, and then the reserve requirement goes away. But 3 to 4 families, those are tricky. They could go FHA, but they have to have 3 months reserves. The house has to be self-sufficient when, like, all the rents have to cover 100% of the mortgage payment. So 2 families are a little bit easier because but then in this market, it's hard to get a seller and an agent, right, to accept an FHA mortgage versus somebody else coming in, you know, that can put, otherwise, if they go conventional, they do have to put down 25% versus FHA is 3.5%.
But for that reserve amount, that could also be like 401k funds as well?
Yeah, they can have it there. Yeah,
so so that could cover that aspect of it,
yes,
right? Okay.
Right. It's not, they don't have to use the funds, put the funds into the transaction, they just have to show that they have it. Yeah. Anybody else have any questions? Good? All right. Thank you.
Thank you so much, everybody. This has been an incredibly informative session. And thank you, most importantly, for the time to come out here and educate us over here and people who are going to see this online at a later point in time. So thank you so much, and thank you for coming over as well. And any questions? Yes.
I just wanted to let you know we're in on the 400 square feet. I checked the guides, and it's for a manufactured home, it's 400. So.
Perfect. Good to know.
Yeah, they're considering, yeah, they must be
Yeah, that makes sense.
Well, finally, thank you, everybody.
Thank you.
Thank you.
Everybody's free to go home.